Many people think the only thing wrong with the economy is the coronavirus lockdown and the social distancing rules that have shut businesses across the country. Of course, the lockdown has been devastating, but the economy was unhealthy before any of that occurred. Before the crisis, we had already record levels of corporate debt, household debt, consumer debt, and student loan debt, and all of this was fueled by cheap debt. It's been called the everything bubble. The pandemic provided an effective pin to burst the bubble. Now, there's a lot of talk about restarting the economy and getting things back to normal. Of course, we want to see businesses back in business and people working again. But let's not get back to normal. I hope we can do better than that. The coronavirus revealed a devastating fact about our personal finances, and that is that most people have no savings. Zip, nada, nothing. That's why in many parts of America, grocery stores are open, but everyone is waiting in line for the food bank. Now, don't get me wrong, I'm grateful that we have the food banks for those people who are in need. But I hope that this crisis can be a wake-up call for both individuals and institutions. Without savings, we have no financial stability or certainty. And today I want to give you some fascinating statistics on the state of debt in America. And then I'll give you 7 keys to get ourselves on firm footing. Welcome to our mini premiere, The Great American Debt Addiction. An alien invasion comes to the United States, threatening to take over the world. Now imagine screams, fear, and drama. How does the U.S. government respond? Well, it cuts interest rates. Now that was a joke that came to me in an email from a colleague, and I think it's funny, sadly, because it's true. The pandemic revealed an ugly truth about our country. We are hopelessly addicted to debt. The cheaper, the better. Debt is an epidemic that has weakened our personal and national financial immune system. And while we can point fingers at the government and the Fed, debt is also an increasing problem that impacts nearly everyone, from manufacturers to farmers, from small business owners to those in the working class. Now, low interest rates may blunt the impact, but what's the real cost of cheap debt? It can artificially inflate prices and undermine the value of our assets. The over-reliance on debt undermines our economy, our citizens, our companies, and the well-being and stability of our country. Now, the debt addiction has also left us vulnerable to the crisis we now face, which, a nearly instantaneous recession, perhaps even a looming depression. We are still grappling with a public health crisis. But when that resolves, and it will, the economic impact could last for many years. So let's take a look at the numbers. What about the corporate debt bubble? Well, U.S. corporate debt has reached an all-time high of $10 trillion according to Forbes. Analysts have determined that the average company now carries $3 of debt to every $1 of earnings. And in 2009, the ratio was $2 of debt to every $1 of earnings. And of course, along with the treasuries, mortgage-backed securities, and other assets, the Federal Reserve is now buying corporate debt, including junk bonds and BBB rated bonds that are sliding quickly into junk territory pretty fast. And what about national debt? The U.S. debt clock puts the federal debt at just below $25 trillion. That's about 10% more than the entire U.S. gross domestic product, and that's according to the balance. We can expect to see the debt continue to balloon with the coronavirus bailouts and monetary policy that has now been coined the term QE infinity. In a financial stability report released back in November of 2019, the Fed warned about record-breaking business debts in the U.S. And the report said that business debt was the biggest risk to the country's financial stability. However, it is also the inevitable result of the Fed's own policies of low interest rates, corporate bailouts, increasing repo market injections, and now this QE to infinity and beyond. What about household debt? In the final quarter of 2019, household debt surpassed $14 trillion for the first time. That's an increase of 4.4% from the previous year. Now, this includes mortgage debt and also things like the U.S. Student loan debt, which has reached a new high of $1.56 trillion with an average student debt load of $32,731. That's also reported by Forbes. The auto debt has risen for 35 consecutive quarters to $1.33 trillion. The average car payment, and of course some households have more than one car, is $550 a month for new vehicles and $393 for used vehicles. And of course, the credit card debt rose to a record $930 billion. Households that use credit cards carry on average a balance of $9,333. So what can be done about the debt addiction? Well, in a perfect world, we would have government accountability and leadership that prevents hedge funds and poorly run companies from collecting bailouts. We would allow well-run companies to succeed and those that invest in stock buybacks rather than long-term stability to fail. This would reward good fiscal behavior and restore confidence in the ability of financial markets to respond appropriately. It also doesn't sit well with many people to be told to have a rainy day emergency fund while corporate America can't get through a couple of weeks of disruption without a crisis. And it seems that, some CEOs have become like college students with bad spending habits. They know that no matter how irresponsibly they act, mom and dad will eventually bail them out. As we've reported in the past, our economy was already challenged with these asset bubbles and overwhelming debt. We may have been heading towards a financial crisis this year with or without the coronavirus. Decades of cheap debt, speculation, and gross mismanagement have made our economy very precarious, to say the least. However, you and I ultimately have very little influence on the actions of the Fed, the president, and Congress, or corporate CEOs and CFOs. As an individual, though, you can't control monetary policy or who gets the next bailout. The only economy you can ultimately affect is your own. And that's really a great place to start. The solutions to financial instability and debt can be simple, not necessarily easy. And here we're going to cover those 7 steps to more financial certainty in your own economy. So the first thing you can do is control your own balance sheet. The economy doesn't have to be your economy. There are always ways to earn money. And as a friend of mine likes to say, you can choose not to participate in the recession. You could look for ways to increase your earnings or create multiple streams of income, eliminate unnecessary consumer debt spending, spend less than you earn, and pay off all high interest debt. Now, we recommend you still borrow for real estate and possibly cars. Utilizing low interest secured debt wisely can enable you to save and invest more. The second thing you could do is don't count on debt to be your emergency fund. Some people fail to save, believing that in a financial emergency, they will be able to use their credit cards, home equity. And this is really a flawed thinking. First, you do not control the companies who may or may not decide to lend to you in a crisis. And already we have seen lending tightening up. Bank of America, Wells Fargo, and other banks have aggressively tightened up lending standards for people who wish to tap into home equity. JP Morgan just stopped accepting applications for HELOCs. And in the Great Recession, we saw banks shrink and even eliminate home equity lines of credit, even for borrowers with excellent credit. And second, remember that borrowing often requires qualifying with proof of income and minimum credit scores. And the time when people most need money tend to be the same time they are least qualified to borrow it. Additionally, the last thing you need during a financial crisis is extra high interest debt payments. Average credit card rates remain at 16.12% in spite of the decrease in the Fed and prime lending rates. The third thing you could do is save a portion of your income. Consistently saving 10, 15, or 20% of your income is the best protection against the lean years. And with discipline and commitment, savings is possible even on modest incomes. And as I've seen with some of the clients that we've worked with, even secretaries, librarians, and janitors can become multimillionaires. The fourth thing you can do is have a system for saving. One thing we love about whole life insurance is that it instills the savings habit. It is a savings account that shows up like a bill. You might have heard me say this before. And although there are several ways to halt or reduce premium payments in a cash flow emergency, it is an advantage to have a structure that strongly encourages consistency. Those who intend to save what's left at the end of the month rarely have adequate savings rates, and people who prioritize saving first succeed. The fifth thing you could do is raise your savings rate. You don't have to accept 1% or less savings rate from your bank. One reason we love whole life as a long-term savings tool is that cash value tends to grow at a rate about 2% above what the banks are paying. The minimum gains guaranteed by policies are more than what banks are currently paying, and in some cases, those minimum guarantees for cash value growth are 10 or 20 times higher than bank savings rates. Dividends issued by the insurance companies increase returns even further. Now, dividends aren't guaranteed, but have been historically paid by mutual life insurance companies for more than 100 years running. And low bank savings rates make people less excited to save and more likely to put their money at risk in the stock market. And while Wall Street loves that, and we can help you with those things too, it is imperative that you have a safe place to store cash. Because of recent Fed actions, we know we'll likely be in a low interest rate environment for probably years to come. And now is an ideal time to lock in the guarantees of whole life. The sixth thing that you can do is maintain access to affordable loans if needed. Now, don't try to borrow in an emergency from a double-digit interest rate card, credit card, or home equity that you can no longer access. Save where you can easily borrow against your savings at a reasonable interest rate while the savings used as collateral keeps growing. When you have these kind of savings, you can provide financing for yourself or your business without having to liquidate assets in a cash crunch. This is what is known as infinite banking. You might have heard of the term. Sometimes we refer to it as cash flow banking. Whole life policies are the best asset to use for infinite banking, as loan rates are low and the underlying asset is guaranteed to keep growing. And then, of course, you've got the death benefit and other living benefits also provide some additional financial security. And it's also good to keep your credit score healthy. It makes a big difference in the amount you'll pay for mortgages, car loans, and even car insurance over a lifetime. And the seventh thing you can do is keep a prosperous mindset. Wealth is ultimately about well-being, not just the bottom line. Nurture your own prosperity and that of those around you. Staying in gratitude. Give to your local food bank and other nonprofits when you can. Find ways to create new income through a side gig or pivoting your business to stay profitable. Keep your eyes open to see who you can help during this time. Now, I had a client recently say to me, during this COVID-19 crisis, they were able to help a couple of their neighbors who lost their jobs. to help keep their utilities on. And they also mentioned that they were at peace during this crazy time because their four walls were covered for the next 6 months. That was their emergency fund. And I love hearing that. Debt is an epidemic, but it doesn't have to kill your wealth. The solution to the debt addiction is keeping your finances healthy, especially in times of unsound monetary policy or recession. The best strategy we know of for growing and keeping money safe in times of turmoil is dividend-paying whole life insurance, structured for maximum cash value. It truly does create a firm financial foundation. And when economic storms arise, those who have built their finances on firm foundations are grateful to know their money is secure and weatherproof. We can provide you with further information, a quote for a policy in the form of an illustration. We can talk about this further if you'd like to know more. We can show you ways on how a policy might perform, both at minimum guarantees and anticipated returns based on current dividend rates. So let us show you how to weatherproof your personal economy. Don't forget to share this video, like, and subscribe to my channel. And remember, every financial decision you make is either creating an opportunity for you or for others. So ask yourself, will this build my circle of wealth? And then go out and live your best life now.